Today I would like to analyze Walmart, one of the largest retail companies in the world. We had an incredible performance in the last 5 years. We are up around 133%. If we're going to take a look at the all-time high, we are down around 9% from that. So we're going to take a look at the financials to find out if Walmart is a good buy right now. The first thing we can recognize is a huge market cap of 773.6 billion US dollar. This makes Walmart the second largest retail company in the world by the market cap. We also have a dividend yield of around 0.99%, which we can see here did grow in a decent rate in the last 10 years. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So in 2020, the revenue was around 523 billion US dollar. Then in 2021, we had the 6.7% increase. So this is a decent growth. Then in 2022, around 2.4% increase. 2023, around 6.7% increase again. So a decent growth. And then in 2024, around 6% increase. So I think in the last 5 years, we had a good revenue growth, so it's a check here. The next thing we're looking for is free cash flow growth in the last 5 years. The free cash is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, the free cash flow was around 14.55 billion US dollar. Then we had a strong increase in 2021, around 77%, so probably related to COVID. Then in 2022, we had a strong decrease around 57%. Then in 2023, we had the increase around 8%, so a decent growth. And then in 2024, we had a strong increase around 26%. So overall, it's still a free cash flow growth in the last 5 years, so it's a check here. If we take a look at the gross income, we can see it increased in every year since 2020. So this is something positive. It means this business is still growing. If we wonder why in 2022 we had a free cash flow decline, we can see here one of the reasons can be the increased inventory cost, timing and payment of wages, and increased capital expenditures as well. So this company invested more money into the business. So this is something positive, I would say. The next thing we're looking for is a free cash flow yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So we're going to take the free cash flow from 2024. So this is around 15.12 billion US dollar. Then we're going to divide it with the current market cap. So current market cap is around 773.66. So then we're going to get the free cash flow yield for 2024. So the number we're going to get is around 1.95%. So I think this is a low free cash flow yield. It could be an indication for overvaluation right now. So it's not a check here. So I think we should also make some assumptions about the free cash flow in the future. If we ask ChatGPT, we can see in 2025 the free cash flow could be around 13.6 billion US dollar, in 2026 around 15.1 billion US dollar, in 2027 around 18.2 billion US dollar. So I'm not quite sure if these numbers are realistic. So let's just assume 18.2 billion US dollar in 2027. So then we're going to divide it with the current market cap, 773.66. So then we would get the free cash flow yield for 2027 with our free cash flow assumptions. So the number we're going to get would be around 2.35%. So again, I think this is quite low, and I think this can be an indication for overvaluation right now. The next thing we're looking for is the debt to free cash flow ratio under 5. This means the company can pay back the debt with the free cash flow in under 5 years. A very important number, because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So we're going to take the long-term debt first. The long-term debt in 2024 is around 38 billion US dollar. Then we're going to add the short-term debt as well. So the short-term debt we can see here around 0.88 billion. This we need to add as well. So all in all, I think the short-term debt would be around 4.35. So then we're going to divide it with the current free cash flow, 15.12 billion. So then we're going to get the debt to free cash flow ratio that we're looking for. So the number we're going to get would be around 2.80. So I think this is a good number. In a little bit under 3 years, we can repay the debt with the free cash flow. So the check here. We can also take a look at the cash on hand, how much money this company has in the bank. We can see here around 9.9 billion US dollar. So I think this is a decent amount as well. So I think this company has a good balance sheet. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So first we're going to calculate the enterprise valuation, the current market cap, 773.66. We're going to add the debt as well. The debt was around 42.44. Take minus the cash around 9.87. So then we're going to get the enterprise valuation. So let me calculate this quickly. So the number we're going to get would be around 806.23 billion. So this is how much the whole company is worth. We're going to add the debt, we're going to take minus the cash. So now we're going to calculate the ratios that we're looking for. So we're going to divide this number with the current free cash flow, 15.12 billion. So then we're going to get the number around 53.32. So I think this is a very high number actually, and this can be an indication for overvaluation. So there's another check here, and we can calculate this for 2027 as well. So then we would get a different number. So the number we're gonna get would be around 44.29. So again, I think this is quite a high number as well, and I think this company does look overvalued right now. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially we think the company is undervalued. So we can see here repurchase of common stocks in 2021 around 2.6 billion US dollar, and in 2022 around 9.7 billion US dollar. So yes, this company buys back a lot of their shares. We like to see that as we think the company is undervalued. So right now I don't really think Walmart is undervalued, but again, this company also has a good balance sheet. So I think they can afford it as well. So it's a check here. I would like to give my conclusion about this company, so let's start with the positive. So I think we had a good revenue growth in the last 5 years. I also think we had a decent free cash flow growth as well. The balance sheet is also looking quite good. This means a low amount of debt and a good amount of cash on hand. The free cash flow yield around 1.95% is looking quite low. So this can be an indication for overvaluation. Also in 2027, with our free cash flow assumption, the free cash flow yield would be around 2.35%, which is also looking quite low. We would like to see it over 4%. So the enterprise valuation to free cash flow ratio around 53.32 is also an indication for overvaluation. We would like to see it under 25. Even with our free cash flow assumptions for 2027, this number would be around 44.29. So I think this company is valued like a technology company, and to me this company is overvalued right now. If you found this video helpful, don't forget to like and comment and subscribe for more content.